And welcome back to halftime. Atlantic Equities out with a note calling U.S. bank valuations attractive for longer-term investors. Bank of America, Morgan Stanley, and Wells Fargo all reiterated overweight. It's our call of the day. Joe, you own Bank of America and Morgan Stanley.
And I also own Goldman Sachs. I bought it back on July 22nd at 318. I believe in the capital market play. I think that persistent and elevated volatility is going to benefit both equity, fixed income trading, and the commodities division for Goldman Sachs, for Morgan Stanley, and Bank of America to a certain extent benefits along that as well. I also think as a second derivative of an improving risk asset environment, you could look towards asset managers, you could look towards exchanges, you could think about a Charles Schwab or a T. Rowe Price or even Virtu Financial. Full disclosure, I maintain a friendship with the CEO and management there, but it's an environment for a company like Virtu Financial where if the environment improves, you're taking advantage of a company that has a very strong buyback program and also gives a very strong dividend as well. So I like that second derivative play.
All right, Snipe, over to you. My colleague Leslie Picker actually recently did a story on regional banks. I know that's what you prefer as well.
Yeah, absolutely. So for me, as it relates to kind of financials, I like the KRE, which is the regional bank ETF. I think for me, the play with financials is loan growth and net interest income. And I think those are business lines that the regional banks really play to. PNC is my favorite name in the space. But to Joe's point on capital markets, Goldman's just the best of breed. The IB environment has been really tough, but from a trading volume perspective and just understanding what's going on in the environment and volumes being what they are, I think Goldman can still do well. So that's where I am on the financials trade.
And Jim, speaking of Goldman, that was your final trade just yesterday.
Yeah, sometimes I get it right. Riffing off of what Jason and Joe just said about capital markets and trading, I think there's another aspect to this, which is the overall big macro picture. If this CPI number today is an omen of what's to come, and maybe the Fed's not as aggressive, then what that leads to is these fears of a recession abate, the fears of credit quality declines that go along with the recession abate. And by the way, if economic activity picks up, you get loan demand growth. All of this is good for the traditional bread and butter lending business of these banks, which is a complement to the trading that's been talked about.
Yeah, Kerry, over to you. You're not in any of the big banks, but you do have some exposure to financials. Explain why you're out of the banks.
Well, I think it's really about their growth prospects. And we would rather own CME, which has been a great stock to work when there's been volatility in the market. American Express, which again benefits from the big travel boom, and also, it is a financial service company in a major way. Blackstone, if we're talking about capital markets, they're an enormous beneficiary as they're invested across multiple asset classes. And Charles Schwab, which has a bank itself. And if markets start to improve, then they'll do better with more active participants on their platform.
So, Jim, I want to come back over to you. Obviously, you're bullish on Goldman Sachs, but you also believe that loan demand is going to increase and that the yield curve steepening is going to be a tailwind for the banks.
Yeah, not everybody can see you, Frank, but you look like you're a little bit incredulous.
No, not at all.
Okay,
I'm just looking at you.
I mean, Joe, it's not me.
I'm just looking.
Just me, right? He did look a little bit.
There was no
skeptical.
stink eye. There was nothing. There's nothing there.
Okay. And again, this goes back. Sorry about that, Frank. This goes back to the overall thesis that I have, which is that, and I know people are tired of saying it, but I got to say it: supply chain onshoring and infrastructure spending is going to propel economic activity going forward for the next 2 to 3 years. All of that construction requires financing. It doesn't matter if you're Intel and you've got to borrow money both in the capital markets and from the banks to build your semi plant, or if you're the general contractor who needs to rent more excavators and dump trucks and stuff. That all requires financing. This is economic activity is very good for the bread and butter lending of banks. That's why they're cyclicals, folks.